Imagine spotting a chart where silver's price has doubled or tripled in recent years, yet the companies digging it out of the ground are trading like they re-stuck in the Stone Age. That's the hidden gem most everyday investors miss, and right now in 2026, silver miners are screaming undervalued, offering millionaire-making potential if you get in before the crowd catches on. Picture this. While silver bounces around $80 to $82 an ounce after that wild ride above $100 earlier this year, top mining stocks are sitting at fractions of their net asset value. Profits are exploding as costs stay low and demand from solar, EVs, and tech keeps surging. If you're ready to uncover why the smart money is quietly loading up on these overlooked plays, stay tuned, because this breakdown could change how you look at your portfolio forever. It helps us keep delivering these game-changing stories straight to you. Let's ease into the story. A few years back, silver was hovering in the 20s and 30s. Mines were barely breaking even, and a lot of companies cut back exploration or even shut down operations because it just wasn't worth it. Fast forward to today, silver's structural deficit, meaning the world uses way more than gets mined, has hit year after year, with forecasts showing another big shortfall in 2026 around 100 million ounces or more. Industrial demand is the rocket fuel here. Solar panels alone gobble up massive amounts, and with green energy mandates pushing harder, plus EVs, 5G, and electronics, that demand isn't fading anytime soon. What about supply? It's tight. New mines take 10 to 15 years to bring online, and despite higher prices, exploration hasn't exploded like you'd expect. That's created this perfect storm where silver itself looks strong, but the miners, the ones who actually produce it, are still priced like the bad old days. Analysts from places like BMO Capital Markets and Stifel are pointing out that many quality silver miners trade at just 0.7 to 0.9 times their net asset value, way below the 1.2 to 1.5 times you'd see in a full bull market. Compare that to gold miners, which are also cheap but not quite as dramatically undervalued relative to their metal. Silver miners get extra leverage because silver moves more violently than gold. When silver goes up 10%, miners' profits can jump 30% or more thanks to fixed costs and higher margins. Experts like Tavi Costa have been shouting from the rooftops that mining stocks remain extremely undervalued relative to metal prices, and we haven't seen anything yet. OAG Funds echoes that valuations are low despite 2025 gains. Profitability is way up with silver well above all-in sustaining costs, and balance sheets are getting stronger every quarter. Now, let's talk real names, because talk is cheap without examples. Pan American Silver, one of the biggest pure-play names, runs mines across the Americas with solid reserves and a track record of delivering. It's trading with room to run as silver climbs. First Majestic Silver focuses heavily on high-grade Mexican operations. Think San Dimas and Santa Elena, and they've been ramping production while keeping costs in check. Then there's Wheaton Precious Metals. Not a miner exactly, but a streamer. They finance mines up front for a cut of future production at low fixed prices, so they get the upside without the operational headaches. It's like owning the profits without the dirt under your nails. Hecla Mining, the big US player, boasts some of the lowest costs, around $15 to $16 per ounce projected for 2026, positioning them perfectly if silver pushes higher. Even juniors like Mag Silver or AbraSilver show up on watch lists for their growth potential and undervalued assets. So why the disconnect? Part of it is sentiment. After the big crash earlier this year, that 30% plunge in days, a lot of retail money got scared off, and institutions haven't fully rotated back in yet. Paper silver on futures markets got hammered by leverage unwinding and a stronger dollar moment. But physical demand stayed robust, with premiums holding up in Asia. Miners suffered double because their stocks are more volatile. But here's the kicker.